Could it be that the current housing price bubble is much bigger than 2008? I want to talk about an article from Zero Hedge. I want to touch on a couple of things, and then let's have a discussion about this in the comment section below. So let's take a look. The current surge in home prices makes the previous bubble in 2008 look quaint by comparison. At the previous peak in 2007, the equity in people's homes was around $15 trillion, while mortgage debt stood around $9 trillion. When the bubble popped, home prices collapsed, flipping homeowners' equity from positive to negative. Home equity is roughly $30 trillion right now, while mortgage debts have increased to roughly $12 trillion. That is an incredible spread, unlike anything seen previously. Now, we've talked about it in other videos on this channel about leading up to the pandemic, pre-pandemic. I personally think that we're going to see values go below pre-pandemic prices in most cases, because I've done other videos on this talking about where we were at pre-pandemic in terms of pricing and the overall health of the real estate economy, and it wasn't that healthy. Things were trickling along. A lot of properties were not selling. A lot of properties were expiring. We, in fact, were selling more expired listings and off-market expired listings than any other properties, because those were likely properties we were getting more deals on. Now, where are we at today? We're at a situation where people have a lot of their net wealth in their homes, in their primary residences. And that is a good thing. However, I've said this in other videos that it's kind of fake equity, or it's not realized equity. It's not a realized gain until you actually sell the property. And I think that we're going to get to a certain point where there's going to be a certain amount of sellers that are starting, and we're starting to see it now a little bit. I think we're going to see it a lot more, where sellers are starting to see their equity position start to go down, go down, go down, go down. And when that happens, neighbors start to talk to each other. People are educated more now than ever before, because you have websites like Zillow and Redfin and all these sites out there educating people on certain estimates of property values. And I know a lot of people pay attention to it. A lot of people look at their property values on a regular basis. And as people start to see their equity position reduce on their property, anybody that's been sitting on the fence, they in fact are going to probably list their properties. And then you have a whole other sector of people who financially might not be able to afford their properties, and then they're seeing their equity position reduce even more, and then they're going to say, you know what, this property's too much for us. We're house poor. Let's get out of it. Let's cash out, take the money we have, and let's run. And I think we're going to start seeing that over this year, over 2023. We're just going to see more and more inventory come to market. Let's jump into one other part into this article that I found pretty compelling. As of Q3 2021, total housing units was about 143 million units. And basically, the author of this is basically saying we do not have a shortage of housing units. And I completely agree. Now we have a shortage of properties on market, obviously. But it goes on to say there are currently more houses than households to buy, such as because several homes are vacant for different reasons, second homes, vacation homes, etc. And you can see in this chart here, total of housing units versus households in the United States. And the red chart is the total housing units. You can see it's much higher than the active population. Now, I put a note here too in terms of STR bookings are down, because it says second homes, vacation homes. There's a lot of vacant homes. And what I'm foreseeing is going to happen is because short-term rentals, the vacation rental sector of the real estate market really exploded over the last several years, especially with people working remote and everything else. They're booking, a month, 2 months, 3 months in different areas because they were able to work from a laptop and not have to be in their office. And now they're requiring people, employers are requiring people to come back to their offices. So a lot of those short-term rentals I foresee are going to get hit in terms of projected income, and they're not going to be making as much income on these short-term rental properties, which is going to lead to people selling those properties. Now, also, the first thing that's going to go for a lot of people when we run into recessionary periods or distressed time frames, especially with unemployment, reduction in pay, job loss, stuff like that, is you're going to see the things that people do not need to survive, and those are going to be the first to go. And right here, one sector of vacant homes are second homes. And a lot, it goes back to the pandemic with people being able to work remotely. And a lot of second homes are probably going to come up on market for sale because people no longer are able to work remotely, and they have to go back into their office, and or the second home is just too much of a liability. Somebody making $300,000 a year, maybe got a cut in pay, job loss, have to go somewhere else. Now they're making $200,000 a year, and the first thing that's going to go is that second home. I currently reside in a community called Pelican Bay here in Naples. This is a short-term rental until we move into our other condo. And I'm on a MLS drip for this community. And I can tell you, literally within the last 60 days, properties have been coming up on market like crazy in this community. And I know, and Pelican Bay is a huge community. I think it's 98 communities in this massive landscape out here across from the Gulf of Mexico. And we're just seeing a ton of inventory coming to market, and I believe a lot of those are second homes. It goes on to say there are three primary issues that lead to changes in the supply of housing. Prices rise to the point that sellers come into market. Interest rates rise, pulling buyers out of the market. An economic recession removes buyers due to job loss. When those occur, transactions slow down and inventory rises sharply. I think we're still seeing the affordable housing, the first-time home buyer market still be relatively strong in a lot of areas. But I think the middle and the high-end properties, I think we're going to start seeing a lot more of those come to market. So as I always like to include in a lot of these messages is real estate is micro. So, I got people that are commenting saying, yeah, it's not happening in our area. We're not seeing inventory. We're not seeing price decreases and so forth. I get it. However, I think that this is going to spread nationwide. I think it's going to hit most markets, unfortunately. And, I think that people that are sitting on the sidelines waiting to see what's going to happen with the real estate market probably should consider selling their properties if they're trying to get into a cash out position, take that equity and move on to other ventures. Anyway, let me know your thoughts in the comment section below, and I'll see you guys on the next video. Thanks for being here.